Welcome to The Explainer. So, if you're running a business, dealing with corporate accounting, or honestly just trying to wrap your head around the absolute maze of fixed asset management rules in Vietnam, well, you're in exactly the right place. Today, we're taking the legal framework of Circular 45 and all its amendments, and we're going to ditch the heavy jargon. We're turning it into a clear, usable roadmap for the entire asset lifecycle arc. Let's get right into it.
I want to kick things off by challenging a really common assumption we see all the time. Does every massive, expensive purchase your company makes automatically get slapped onto the fixed asset ledger? Like, what if you buy a wildly expensive high-end laptop or drop a fortune on a massive marketing campaign? The short answer, absolutely not. The legal line between an everyday business expense and a true fixed asset is way stricter than most folks realize.
To navigate this, we've got a quick 5-part roadmap. We'll hit identifying assets, determining historical cost, the classic upgrading versus repairing dilemma, principles of depreciation, and finally, depreciation methods.
All right, Phase 1, identifying assets.
This is exactly where we separate those everyday expenses from your actual business workhorses. And to do that, we use what we call the Big Three criteria. By law, a purchase has to hit all three of these rules at the exact same time to be classified as a fixed asset. First up, you've got to be absolutely certain it's going to yield future economic benefits. Second, its working lifespan literally has to exceed 1 full year. And third, the original value must be reliably determined and hit a minimum of 30 million Vietnamese dong. If a purchase misses even a single one of these, like say it cost 40 million dong but only lasts 6 months, boom, it's just not a fixed asset.
Now, when we talk about these workhorses, the most obvious ones are your tangible fixed assets. These are the physical things you can actually go out and touch, right? Factory machinery, delivery trucks, the office building itself. They participate in multiple business cycles, meaning they show up, do their job day after day, year after year, all while keeping their original physical form. But we've got to contrast that with intangible fixed assets. Think of these as your invisible workhorses. We're talking land use rights, complex software, patents, copyrights. You obviously can't touch a patent, but it holds massive invested value. But here's the kicker. These invisible assets still have to meet those exact same Big Three criteria we just talked about to earn their official spot on the ledger.
Moving right along to Phase 2, determining historical cost.
Getting this initial valuation right is absolutely critical because the number you record on day one, that dictates your tax deductions for years to come. Imagine you buy some brand new machinery and the base invoice price is 119 million dong. You might think, okay, great, that's my historical cost. But that initial sticker shock is rarely the final number. What if you negotiated a trade discount or had to pay out of pocket for installation? The actual math requires a little more digging.
So here's exactly how you arrive at that true historical cost. First, you have to add in things like import taxes, shipping fees, and whatever it costs to install and test run the equipment just to get it ready. But there are strict exclusions too. Going back to our 119 million dong machine, if you manage to get a 5 million dong trade discount, you have to subtract that. But then, if shipping and installation costs 6 million, you add that back in. So 119 minus 5 plus 6, your true historical cost is actually exactly 120 million dong. Make sense?
Okay, Phase 3, upgrading or repairing.
So your asset is up and running, but eventually it's going to need some work. And this brings up a crucial legal distinction. An upgrade literally boosts the workhorse's fundamental value. Maybe it increases capacity, improves product quality, or extends its lifespan. If it's a true upgrade, that cost gets added directly to the historical cost. On the flip side, a repair simply restores the machine back to its original standard working condition. You're just fixing what's broken. Repair costs do not get added to the asset's value. Instead, they're expensed into your regular business costs, usually spread out over a maximum of 3 years. Just a quick word to the wise here. Misclassifying a simple repair as a major upgrade, or vice versa, is a fantastic way to invite audit penalties, so definitely tread carefully.
Now for Phase 4, principles of depreciation. As your asset ages, we have to systematically write off its value over time. And the universal baseline rule here is actually pretty simple. All existing fixed assets participating in business operations absolutely must be depreciated. It's a mandatory financial compliance step. You are legally recognizing the physical wear and tear on that asset as a legitimate business expense. But of course, the law does carve out some very specific exceptions.
There are strict rules on when to stop, or honestly when to never even start depreciating. For instance, you don't depreciate an asset if it's already fully depreciated, even if you're miraculously still using it.
You also skip lost assets, or assets you don't actually own, like in a standard operational lease. Certain employee welfare assets are excluded unless the law specifically allows them, and really importantly, long-term land use rights that have an indefinite term are not depreciated. Knowing these exceptions is exactly how you keep your ledger completely legally sound.
So how do we actually set this up in practice? Well, here are the exact procedural steps. Step 1, determine the base lifespan by looking at the government's mandatory timeframe frameworks. You'll find those in Appendix 1. Step 2, if you bought a used asset, you have to adjust that timeline based on its fair value compared to a brand new one. Step 3, calculate that monthly deduction. And Step 4, you start deducting from the exact day, not the month, but the exact calendar day, the asset officially enters operation.
Finally, Phase 5, depreciation methods.
How exactly do we do the math here? Well, the law allows for 3 distinct methods, and picking the right one can have a massive impact on your cash flow. The first option is the straight-line method. This is definitely the most common and straightforward approach. The asset's value is written off by an identical, steady amount every single year. So if your asset depreciates by 12 million dong in year 1, it's going to be exactly 12 million in year 2 and 12 million in year 3. It's super predictable and really stable for your financial planning.
Now, contrast that with the declining balance method. With this one, in year 1, you might write off a massive 20 million dong, but by year 3, that drops down to just 7.2 million. You're strategically writing off way more value up front. This is explicitly designed for fast-changing tech, think advanced electronics or high-end measurement tools, where the asset loses its technological edge really rapidly in those first few years.
And lastly, we have the units of production method. Instead of tying depreciation to the calendar, this method ties it directly to the physical labor of the workhorse. If you own a heavy excavator, you depreciate its value based on the exact number of cubic meters of earth it actually moved that month. If it sits totally idle, depreciation stops. It's a great way to perfectly match your expenses to your actual factory output.
Wow, we've covered a massive amount of ground today. But before we wrap up, I want to leave you with one final provocative question. Have you been leaving tax benefits on the table by misclassifying your fixed assets? I highly encourage you to take this roadmap, pull up your own asset ledgers, and give them a thorough review. Because it's not just about avoiding penalties, right? It's about maximizing your business's overall financial health. Thanks so much for joining me for this explainer, and I really hope it helps you finally take total control of your asset lifecycle.